Thank you, John. I know John touched on it, but to formally introduce my colleagues, in addition to John, at the stage we have Jim Gowans, our co-president, Sean Usmar, Senior Executive Vice President and CFO, and Darian Rich, Executive Vice President, Talent Management. Before I begin, I'm obliged to draw your attention to this cautionary statement regarding forward-looking information. And I should say some of what you'll hear during my remarks are consistent, and I hope they don't sound repetitive with what John said, but we find it, it's important, and these are messages you'll hear from us consistently over time. As John articulated, 2014 was a transformative year for us at Barrick. We're now in a different place than we were a year ago. Much has changed, including our strategy, our culture, our leadership, and our operating model. As John mentioned, all of these changes are part of a larger plan designed to take Barrick back to the future. In essence, what this means is returning to our roots where the cultureship model, a partnership culture, a strong balance sheet, and the clear focus on gold were all part of our DNA. We've been working very intensely to reestablish these characteristics, as John touched on, and we've been very clear about our priorities. They're to restore our balance sheet and to leverage our considerable strengths, which include the best assets and people in the industry, all to unlock the full value that exists within Barrick. Before I move on, it goes without saying that we're not satisfied with our share price, not at all. However, and while there's still plenty to be done, we're confident that the actions we've taken so far have positioned us to deliver sustainable long-term value. We have the right team, the right structure, and a clear strategy in place. And we're encouraged by the positive feedback we've received from our shareholders since we articulated our plans more clearly with our year-end results. Now it's all about execution, and you can count on us to be 100% committed to deliver on our objectives. And we're convinced the results will be reflected in a better share price performance. Let's take a look at how we did in 2014. Thanks to the quality of our assets, particularly our 5 core mines in the Americas, and the strength of our people running them, 2014 was an excellent operating year. We set out to produce 6 to 6.5 million ounces of gold, and we met our guidance, and we significantly outperformed our initial all-in sustaining cost guidance. In fact, we came in much lower from the year at an all-in sustaining cost of $864 per ounce, which was industry-leading. Looking at our 5 core mines, which contributed about 60% of our production last year, the performance was even stronger, with an all-in sustaining cost of $716 an ounce. This reflects the success of our ongoing drive to reduce costs across the company, and that sharp focus on cost reduction is continuing. To put this in context, our 2014 all-in sustaining costs were 15% lower than in 2012, where they were over $1,000 an ounce. This is substantially lower than the average all-in sustaining cost of our senior peers, and about $400 per ounce below the average spot gold price. At $2.2 billion, capital expenditures also came in below the low end of our guidance range of $2.4 to $2.7 billion. Turning to the performance of our copper business, we met our cost guidance and came in just below production guidance owing to a minor equipment failure at Zaldivar, which was quickly resolved. Moving on to our financial results, we reported annual adjusted net earnings of $793 million. A net loss of $2.9 billion for the year reflects $3.4 billion in impairment charges, primarily related to Lumwana and Cerro Casale. Operating cash flow for the year was $2.3 billion. I'm pleased to report that 2014 was the best safety year in the history of our company, and that reflects the focus we have on safe and responsible mining throughout our organization. However, despite our improved overall safety performance, we deeply regret the loss of one of our colleagues last year in a workplace accident. It's a sad reminder for us that our job isn't done till everyone at Barrick returns home safe and healthy every day. In 2014, we were named the mining industry leader by the Dow Jones World Sustainability Index. It's the first time we've ever reached that level of distinction, and we're also very proud of our colleagues around the world who achieved that milestone. In 2014, we took a number of strategic actions to begin restoring the focus, discipline, and drive that underpinned Barrick's early success. The most critical element, as John indicated, is a return to a partnership culture and the decentralized operating model. We've eliminated management layers between Toronto and our mines. We've pushed authority and accountability down to the operating level That's where best decisions are made in real time and most efficiently. And we've removed the bureaucratic overlays which would otherwise have prevented that. As part of our return to Barrick's original culture, we've elevated the importance of talent management, as John indicated, and we've spread that throughout the company. Barrick's always been known as a company for having deep bench strength, and we intend to maintain that. Turning to our reserves, we reported 93 million ounces in this category in 2014. We continue to use a conservative gold price assumption of $1,000 per ounce, unchanged from 2013. This is below our gold price outlook and current spot prices, and it underscores our determination to maximize free cash flow and returns from our high-quality reserve base. Approximately two-thirds of the reduction in reserves from 2013 were due to ounces processed and some asset sales. As Jim will discuss, our exploration is focused primarily on near-mine opportunities, and we see very strong potential to convert a significant portion of resources, particularly at our Nevada projects, into reserves over the next several years. Not only the quantity, but the quality of our reserves is industry-leading. Our 2014 reserve grade was 1.37 grams per ton, compared to the senior peer average of 0.9 grams per ton. And if you look at just our 5 core mines, they have an even stronger grade profile of 2 grams per ton, which is more than double the senior peer average. Now let's look at our priorities for 2015. With the actions we took last year, we entered this year with great momentum. We've set clear goals with a driving focus on maximizing free cash flow per share and shareholder returns. A conservative financial approach has always been one of Barrick's hallmarks, and no priority is more important to us than restoring our balance sheet to a position of strength. We outlined concrete plans to achieve this with our fourth quarter results. We intend to reduce our debt by at least $3 billion this year, and to do that, we'll use 3 key levers. The first lever is by maximizing free cash flow through the decentralized and lean operating model that John has described. In that, there'll be more efficient capital spending and reduced G&A, and we'll expand on that in a moment. The second lever is through disciplined non-core asset sales, beginning with Porgera and Cowal. Now, this isn't an easy market in which to sell properties, but nonetheless, we're seeing that there are serious buyers for strong interest in quality assets, and that obviously includes Cowal and Porgera. Numerous companies have participated in the sales processes, and detailed due diligence on both assets are now underway, including visits to both properties, which are ongoing as we speak. In a few minutes, Jim will describe the work he and his team have been doing for the past number of months to ensure that we know the full value potential of each of our assets. This work is extremely important since, as we've said, we'll only move forward with any transaction on terms that we know are favorable to our shareholders. The third lever for debt reduction is by entering into joint ventures or strategic partnerships where it makes sense for us to do so. As an example, we've just announced a sale process for a partial interest in our Zaldivar copper mine, and that's receiving extremely strong interest. From a liquidity perspective, we have $2.3 billion of cash and an additional $4 billion available on our fully undrawn credit facility. We also have a modest debt repayment schedule over the next few years, with less than $900 million due through 2017. I'd like to elaborate a little bit more on John's remarks with respect to how taking Barrick back to the future is going to support our goal of delivering positive free cash flow this year. When I joined Barrick 13 years ago, it was known for its achievements and its potential. It was by far the go-to name if you wanted to own a gold equity or be part of a dynamic gold company. Barrick's decentralized operating model meant it was nimble and entrepreneurial and had minimal bureaucracy, and that's what we're returning to. In essence, one way to think about what we're doing is unclogging the arteries, so we're allowing for more efficient information flow and higher quality decision-making throughout the company. This has empowered our mine general managers and our country executive directors to focus on maximizing free cash flow, and we've seen positive results from that already. And in turn, as John also indicated, the head office focuses on 2 key mandates: setting strategy and allocating financial and human capital. To align with this, we reduced the size of our head office by close to half this year, from 260 people to 140, and that's down from about 370 in 2013. These reductions haven't been easy, but they were necessary to reestablish a lean business that will drive material savings for the company. We're targeting $30 million of G&A savings in 2015, and that'll grow to $70 million on an annualized basis in 2016. We've also launched a thorough review of 2015 and 2016 sustaining capital, and we're pleased to show a reduction in 2015 CapEx guidance, which we'll discuss in a moment. To ensure that all new investments align with our strategic focus and maximize free cash flow per share, we've adopted a new approach to capital allocation, which includes significantly more rigor, more detailed life-of-mine planning, and minimum return thresholds. We expect our portfolio to deliver a 10 to 15% return on invested capital throughout the metal price cycle. New projects will be assessed against the high end of the range of the hurdle rate at 15%, and they must have a strong execution plan to support them. This means projects delivered on time and on budget. That's what Barrick was always known for, and that's what we'll be known for again. In addition, existing mines will compete for capital, and those that are unable to meet our objectives over time will be harvested, suspended, or sold. We'll carefully monitor progress and conduct post-investment reviews to evaluate how we've lived up to our original promises and using what we've learned to improve in the future. All capital spending for 2015 and 2016 is also being reassessed against the 15% hurdle rate. Expenditures that don't meet our capital allocation objectives will be canceled or deferred. An initial review of the 2015 CapEx budget identified $200 million in savings. These reductions have been partially offset by an increase in sustaining capital following our decision to continue with operations at our Lumwana mine in Zambia. As a result, our total CapEx guidance for 2015 so far has been reduced by $100 million. We expect further reductions as we continue to challenge the capital budget, and we'll report our progress on that as we move through the second quarter. Now I'd like to provide an update on our 2015 operating guidance, as well as comment on our production outlook for 2016 and 2017. For 2015 overall, we expect gold production from our current portfolio to be between 6.2 and 6.6 million ounces. Our all-in sustaining cost guidance of $860 to $895 per ounce continues to be the lowest of the senior producers. And of this, our 5 core mines are expected to produce 60% of our gold this year at a very low average all-in sustaining cost of $725 to $775 an ounce. About 40% of our gold production will come from Nevada, which constitutes, I don't know if I got that right, Nevada, which constitutes our 2 core mines, Cortez and Goldstrike, and an emerging core mine at Turquoise Ridge. Jim's going to talk more about Turquoise during his presentation. And we've indicated that our production from the overall current portfolio is expected to exceed 6 million ounces for 2016 and 2017, with all-in sustaining costs dropping below 2015 levels by 2017. We've improved our copper production guidance and now expect to produce 480 to 520 million pounds of copper this year, reflecting the recent positive developments in Zambia. C1 cash cost guidance of $1.75 to $2 per pound remains unchanged. Following an extensive period of constructive engagement with Zambian President Lungu and his administration, last week the Zambian government proposed amendments to its existing tax regime. These changes will allow Lumwana to continue operating, generating free cash flow at current copper prices. Our operations and technical team have done terrific work at Lumwana to bring down the cost structure, and we think there's still room to improve. Turning to our first quarter results that we reported yesterday, we were pleased that production and costs were in line with our expectations. We reiterated our 2015 gold operating guidance, and we continue to expect production to be second half weighted, with 55% of production and at 20% lower cost than during the first half of this year. And as mentioned, we reduced our capital expenditure guidance, and our ongoing debt reduction process is well underway. Finally, we announced an exciting new gold discovery in South America called Alturas, which Jim is going to discuss in a few minutes. Just a quick word on Pascua-Lama and what we're doing while it remains on care and maintenance. The team is working through various legal and permitting matters and minimizing our holding costs, as John indicated, while they develop an optimization plan for the remaining construction. If this plan aligns with our objectives and has a minimum return on invested capital of 15%, we'll move forward, but not before. I'm pleased to say we've had some positive news at the project. On the legal front, the Environmental Court in Chile recently confirmed that Pascua-Lama has not damaged glaciers in the area. An information sharing agreement we signed last year with a number of Diaguita, local indigenous groups, made a significant step toward building trust and establishing dialogue. And there's work to be done, but we're encouraged by our progress, and we'll continue to build lasting relationships with local stakeholders in the Pascua-Lama area. You may have heard there was a state of emergency in Chile recently owing to very high rains and flooding. Our Pascua-Lama team worked nonstop throughout that event, assisting the government of Chile in its emergency evacuation and relief efforts. In many instances, our team on the ground were responsible for saving the lives of community members, and we're very proud of them for making that priority one. So when we talk about partnership, we really mean it. It's not just words. It's doing things and being there for the communities where we operate, and that's something that's characterized Barrick from its very beginning. Building strong relationships with our host governments is a central component of our partnership philosophy, and it's essential to our success as a company. I mean, John underscored that, and I think it just, we can't repeat it enough. This approach also has its roots in Barrick's original DNA. It's something that our founder championed, and I've seen it in action many times, and it's central focus and continues to be that for the company today. The more we can work with local businesses, the better it is for everyone. For Barrick, it means more competitive pricing and reduced costs. For businesses and governments, it means more dollars injected into the local economy and a thriving private sector. And the opportunities are significant. In 2014 alone, Barrick purchased about $7 billion in goods and services from local and national businesses in the countries in which we operate. Partnering with local and indigenous communities is a key element of our approach to responsible mining, and we're careful to ensure that local shareholders share in the benefits of our business. For example, in Peru, we recently concluded a 3-year program with World Vision, a leading NGO, and the Government of Canada to improve economic opportunities for the communities around our Lagunas Norte mine. That was achieved by training small business owners in better management and administration. We helped local farmers improve crop productivity, and we encouraged women entrepreneurship through microfinance and small business loans. We're proud that the partnership was recognized by the Inter-American Development Bank as one of the most innovative development projects in Peru last year. And while I'm on the topic of partnership, I also want to highlight an exciting initiative right here in Toronto. We've partnered with the Pan Am and Para-Pan Am Games to be the exclusive provider of gold, silver, and copper to be used in creating medals for the Games this summer. The medal has been sourced from 3 of our mines in the Americas. So the bronze medals will be made from copper from our Zaldivar mine in Chile, the silver medals from our silver produced at the Pueblo Viejo mine in the Dominican Republic, and we're very proud that the gold comes from our Hemlo mine right here in Ontario. We love the symbolism in that. You're welcome to take a look at the medals. They're on display in the lobby. We're obviously biased, but we think they're very beautiful and hope you'll agree. So with that, I'll turn it over to Jim to cover another key objective for 2015. That's unlocking the value in the Americas from our high-quality assets and our projects. Jim?
Thanks, Kelvin. Ladies, gentlemen, good morning, fellow owners and investors. The superior quality of our portfolio is underpinned by our 5 core mines in the Americas: Cortez, Gold Strike, Pueblo Viejo, Lagunas Norte, and Veladero. These mines are among the best assets in the industry, and they anchor our focus in the Americas. We have strong competitive advantages in these regions due to our strong operating experience, our technical and exploration expertise, and our established partnerships with governments, communities, and our suppliers. As Kelvin indicated, we expect them to account for about 60% of our production in 2015 at an average all-in sustaining cost between $725 and $775 an ounce. This is significantly below the industry average costs and current gold prices for the reason that Kelvin mentioned: their higher average reserve grade. The strong operating cash flow from these mines provides us with an unrivaled platform to generate returns for our shareholders, even at today's gold prices, while offering exceptional leverage for higher gold prices. We have excellent operating teams at each of these sites, which is critical for their success. But as well run as they are, we knew that there was more value to be found. We are well advanced on a value realization studies for 10 operations, including our 5 core mines. These studies are headed up by a team of our top mining and technical experts. We have identified a significant potential to add production and reserves, reduce our costs, and extend the mine lives. The benefits of these studies are twofold. One, they will ensure that we understand the full value of every mine before we proceed with any divestiture. And two, they are providing us with concrete opportunities to improve efficiencies and reduce our costs. So let's look at some examples. At Cortez, a considerable portion of the value potential lies in a high-grade zone below the Cortez Hills open pit, which I'll talk about more in a minute. Our Pueblo Viejo mine is now the only mine in the world with annual production of more than 1 million ounces annually, and we expect it to produce at this level with an all-in sustaining cost below $700 an ounce for at least the next 3 years. The study there has identified some key initiatives to create substantial additional value. These include, as John mentioned, the potential to convert another 7 to 8 million ounces of resources into reserve, to reduce costs by switching our fuel and power supply to cheaper liquefied natural gas, and to increase plant throughput. At Goldstrike, we're improving the economics by accelerating cash flow of about 4 million ounces stockpiled through a newly installed thiosulfate processing circuit, or TCM as we call it. We poured our first gold there last November and will be ramping up throughout 2015. Overall, we expect Goldstrike to continue producing at about 1 million ounce level for the next 3 years at an all-in sustaining cost below $900 per ounce. At Valadero in Argentina, we see potential to lower costs through improved heap pad recovery and maintenance activities, as well as reduced contractor costs. And finally, at Lagunas Norte, we are looking at an option to significantly extend its life by mining the refractory ore below the current pit, and expect to initiate a pre-feasibility study on this. We first looked at this opportunity a few years ago. At that point, the economics weren't favorable, but now considering a significantly smaller pit to mine only the higher grades and requires less initial capex. This opportunity isn't currently reflected in our resources, so it represents pure upside. Before I move on to our project pipeline, I want to spend a moment on innovation. We recognize that new technology plays a key role in unlocking the full value of our assets, and our technical expertise gives us significant competitive advantage in this regard. This expertise is one of the first things that stood out to me when I joined Barrick early last year. I'd like to highlight a couple of examples of innovation that we're quite proud of. The first one, which I just mentioned, is our patented TCM technology at Goldstrike, or for you processing junkies, the TCM stands for total carbonaceous material. This is a leaching process that does not use cyanide, and it's the only commercial use of this technology for gold processing in the world. We're now looking at where else we can apply it. The second is a new flotation technology that we've developed that can use seawater, which reduces the demand for scarce freshwater resources. This process is also cyanide-free, and we'll be using a variation of it at Jabal Sayid towards the end of this year. Beyond these opportunities, our exploration group has generated a number of tremendous growth prospects in Nevada and the Andes. Barrick's geologists are second to none, and they've discovered new sources of gold for us at low average finding costs of just $25 per ounce over the last 25 years, which is about half the industry average. We've also entered into an innovative 5-year strategic partnership with QPX to explore for gold and copper deposits in the highly prospective but underexplored areas of northern Chile. Getting back to our own development opportunities, we're completing 4 pre-feasibility studies this year. In fact, we've already completed 1 at our mines around Nevada, some of which could begin contributing significant new production within the next 4 to 6 years. These projects all align with our regional focus, and they have high potential to meet or exceed our minimum hurdle rates. Turquoise Ridge, which Kelvin mentioned, is one of our most exciting opportunities. At 17 grams a ton, it is our highest reserve grade mine, but production is currently limited by haulage and ventilation constraints. We've completed the pre-feasibility on the second shaft, which would accelerate more than 1 million ounces of production and roughly double the output, which we have 75% to an average of 500,000 ounces per year. This expanded production is expected to have a low all-in sustaining cost between $625 and $675 an ounce. This project has strong economics, including a payback of about 2.5 years, and could contribute production in 2019. Our Gold Rush project, located about 6 kilometers from Cortez, or I say over the hill, is one of the best discoveries of the last decade. Gold Rush is truly in a class of its own and is the only significant greenfield discovery by a major gold producer in the last 6 years. It already has about 16 million ounces of resources, and there is excellent potential to expand this further to the north, which we've begun working on already. We expect to complete a pre-feasibility study by about year-end. And at Cortez, we'll finish a pre-feasibility study later this year for an expanded mining scenario, which would include the oxide zone below the open pit. This zone is higher grade compared to current areas of underground mining at Cortez, which could have positive implications for processing costs. And the limits of this zone still yet to be defined. At Spring Valley, located about 75 miles west of Cortez and south of Winnemucca, it's a low capital cost heap leach project with excellent potential to become another standalone mine for us in Nevada. We expect this pre-feasibility study to be completed in late 2015. I'd now like to turn to our new Alturas project in South America. This is a significant discovery which is located in one of our core regions, the Andean region of Chile. Several years ago, our exploration group embarked on a reevaluation of the 140-kilometer-long El Indio belt, which Barrick controls almost all the prospective ground. This area is host to some of the world's largest gold deposits, including our own Veladero and Pascua-Lama, and it's why this region continues to be core for us. We've identified numerous targets, but Alturas was a clear front runner. It's located about 30 kilometers south of the old El Indio mine. The geology is similar to Veladero, as it looks to be mostly oxide, but it could be significantly higher grade. So far, we've completed 35 core drill holes, and the mineralization appears to be thick and continuous. We've identified an area greater than a square kilometer, but we believe that there's a lot more to be found here. Alturas is just one part of a very large system which extends well beyond the area of current drilling. So let's look at a cross-section to see how the deposit sits on the surrounding topography. We've had some great results to date. two of the best drill intercepts is 168 meters at 1.7 grams per ton and 97 meters at 4.4 grams per ton, both starting from a depth of less than 200 meters. I invite you to look at some of the samples of this drill core at our booth after the meeting. Alturas remains open in multiple directions, and our focus going forward will be on defining its full extent, as well as exploring for additional targets nearby. Given its exceptional potential, we are advancing Alturas as quickly as possible, and we expect to report an initial resource with our year-end results. We also look forward to updating you on our other exciting developments at our projects in Nevada, Turquoise Ridge and Cortez, etc., throughout the year. So with that, I will pass it back to Kelvin for some concluding remarks. Thank you.
Thanks, Jim. Well, to wrap up, 2014 was a year of fundamental change at Barrick, and it gives us great confidence for the future. I hope you can see from what we presented that we're very enthusiastic about the potential within Barrick, and we're laser-focused on unlocking its value. We'd like to leave you with 3 key points. First, our high-quality portfolio continues to perform exceptionally well. We have an attractive project pipeline, including the very promising new discovery you just saw in South America, Alturas, all of which have the excellent potential to meet our investment hurdle rate. Second, we're serious about restoring a strong balance sheet, and we're confident that we'll meet our debt reduction target. And third, we're well on our way to returning to the simple and powerful model that made Barrick successful: lean, nimble, and driven to deliver superior returns for our shareholders. In closing, we'd like to thank our founder and chairman emeritus, Peter Munk. In fact, if I can make a comment, I've worked with Peter for 13 years now. Of course, for the first 10 of those, he thought I worked in the mailroom. But it's been a single privilege to be able to have that time spent with you, Peter. I appreciate it, and I've had the opportunity to work with the Grand Master. I'd also like to thank our chairman, John Thornton, and all of our directors for their guidance and support for our actions last year and their continued encouragement so far this year. When I say encouragement, they press us, trust me. We'd also like to convey our sincere gratitude to the truly exceptional people throughout the company in Barrick, around the world. They made great contributions last year in the transition we went through, and we want to make sure that's recognized. And very importantly, we'd like to express our deep appreciation to our shareholders, many of whom have given us valuable and constructive feedback. We're grateful for your support, and we intend to earn it even more. That concludes our presentation.